Well, looking at stocks retreating once again this morning after bouncing back briefly on Monday. Major indices starting off 2024 with the worst open to a year since 2016. But will it be sunny skies from here, or will markets be rockier than expected in 2024? Joining me now is Sonders, Charles Schwab Chief Investment Strategist. So Liz, is there good news to be found at this point? Is it too early to say just how much volatility we'll continue to see from here?
I think it is obviously too early to tell. We're only at the very beginning of January here. But last year, of course, had a characteristic of extremely low volatility, at least on the equity side of the equation. Whereas on the bond market side, that's where you saw the most rampant volatility. And I still think that there's connectivity here with the bond market, particularly yields and stocks. We've moved back into this inverse correlation between yields and stocks. And I think at least through the point where the Fed doesn't just talk about pivoting, but they actually pivot to a cutting cycle, I think yields for the most part will remain in the driver's seat for stocks this year.
And Lizanne, we did see people with some profit taking, especially after the rally led by the Mag 7 here.
Yep.
What does the outlook look like now? Because it's a bit of a mixed picture here, and we're going to expect a lot out of these earnings calls to get a bit more detail as to where these profits are going to come from and what the margins are looking like.
Yeah, I mean, there was no doubt that many of those names, the Magnificent Seven, were a bit stretched, overbought in technical terms. The concentration problem was fairly acute, and I think that's why you saw profit taking concentrated in those areas come in at the start of the year. Really began at the very end of last year, and you have seen significant improvement in relative terms by equal weight versus cap weight, and I think that will be a characteristic of 2024. Not every day, not every week. Yesterday, you saw a big move back up in those names, and it just shows you if there's good news. Yesterday was the case of some good news out of NVIDIA, that there's still interest in those areas, but then you had multiple downgrades by a couple different Wall Street firms among the Magnificent Seven. And it also shows you that there's quick profit taking that kicks in. So I do think it's a year that active management is on a more level playing field with passive, and that equal weight will probably in general do better. That said, I wouldn't sacrifice quality if you're going down the capitalization spectrum. Stay up in quality.
And so as we did see the rally at least somewhat broaden, what are some of perhaps the names that aren't getting as much love and attention that could, and which ones do you see having more upside right
Well,
now?
I don't cover individual stocks at all. So I think again, what we focus on, the farthest we go sort of down from the 30,000-foot view is on factors, which is just another word for characteristics. And I think there's a lot more focus these days on investing based on or screening for factors versus monolithic sector-based calls. And the factors that we continue to emphasize, which have this quality wrapper around them, are factors like high interest coverage, strong free cash flow, positive earnings revisions, positive earnings surprise. And I would apply that factor screening, as I mentioned, even if you go down the cap spectrum, because in particular in an index like the Russell 2000, you still have a hefty share of that index that is not profitable, almost a third of a share of that index that are zombie companies, don't have the cash flow to pay interest on their debt. So that's the type of focus we bring into the mix as it relates to stock pickers out there.
And of course, as we look at not just what's happening with the market, looking at what's happening with the Fed and what we saw with December's jobs numbers, really surprising there. How does that change the tone for investors coming into this earnings season?
Well, I would say the December jobs report, which we just got last Friday, the headlines were positive given the better than expected payrolls and no change in the unemployment rate, but the details were much less healthy or robust. You had the Bureau of Labor Statistics, they do a business birth and death adjustment every month, and that flattered the payrolls number by more than 100,000. Weather was also somewhat flattering. And the household survey, from which the unemployment rate is calculated, that saw a decline of 683,000 jobs. You also had a decline in the labor force to a similar degree, which is why the unemployment rate stayed the same. That's sort of the bad reason or the wrong reason for an unemployment rate not going up. But the wage number had ticked up. And I think that was probably the one piece of the December jobs report that added some cloudiness to the Fed outlook. We even prior to the December jobs report, we felt that an expectation of 5 or 6 rate cuts this year, starting as soon as March, was a little aggressive, and that what the Fed is probably going to key off of when they decide to actually start cutting is not just disinflation continuing, but the labor market, which is their other mandate, coming into clearer focus. And I think the mix of what we saw in the data, if anything, reinforced that view that maybe early March is a little too aggressive.
So, Lizanne, in terms of what you'll be watching for then going forward, in terms of some of the markers that we might see some sort of change in the market, is it going to come down to a Fed pivot at some point, or are there some other underlying factors that you think aren't getting as much attention?
Obviously, the market is very focused on the Fed pivot, and there is still a yawning gap, as I mentioned, between the market's expectation and what is picked up in terms of an expectation in the Fed's dots plot. And I do think that will correct by the market having to move a bit more toward what the dots plot show, meaning, yes, I think rate cuts will start this year, but maybe a little bit later. And I think that perspective around Fed policy and how the bond market reacts to that, both in terms of shorter term yields, but also longer term yields, at least for the first few months of the year. That's what I think all investors should keep a close eye on. Obviously, the inflation reports that come in are going to grab a lot of attention, but it's in conjunction with labor market reports, not just the monthly, but unemployment claims, both initial and continuing, the quits data that you get out of JOLTS, some of the regional Fed data on employment. I think you want to stay very focused on employment data, not just monthly jobs reports.
Indeed, because we do tend to see those knee-jerk reactions from the markets as they're really sort of honing on a month to month and not taking a holistic view of what's happening overall. Appreciate you for joining us. Lizanne Sonders, Charles Schwab Chief Investment Strategist. Thank you so much.
Thanks.